You know, you don't find out who's been swimming naked until the tide goes out. And
that has got to be one of my all-time favorite Warren Buffett quotes. You don't know who's swimming naked until the tide goes out. It talks about using leverage. It talks about not using the cash that you actually have and what detriment that could cause if things start to go wrong. And that's the way that I live in my personal life. Huge Buffett fan. And what this video is about, and kind of what a new series that I'd like to introduce, is I've been going through and I've been listening to all of the Berkshire conferences, the annual conferences that they have. And I've been picking out key lessons that I've been taking as notes, and I thought I would put them together as a video towards you. So there's going to be a lot of context here, and the video might extend a little bit longer, but I'd like to let you listen to the way of thinking of one of the greatest investors of all time. And we'll break down in different segments. I'll try and keep my portion as quick as possible to let it go through, but please let me know if you enjoy them. There's definitely a lot, a wealth of knowledge in terms of the questions that are asked and the feedback that's there. If you want to go and take a look at the investor reports yourself, or take a look at, listen to them in a podcast, I'll link the podcast link down below. But if this is your first time here, my name's Nick. Welcome to Waste of Wealth. Before we get into the video, if you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. I would definitely appreciate that. With no further ado, the first part that we're going to be talking about is Warren's expectations for results. So let's take a listen to the GOAT.
you don't have to do exceptional things to get exceptional results. And some people think that if you jump over a 7-foot bar, that the ribbon they pin on you is going to be worth more money than if you step over a 1-foot bar. And it just isn't true in the investment world at all. So you can do very ordinary things. I mean, what is complicated about this? But, you know, we're $3 billion pre-tax better off than we were a few years ago because of it. There's nothing that I know about that product or its distribution system, its finances, or anything that really hundreds of thousands or millions of people aren't capable of. They don't already know. They just don't do anything about it. And similarly, if you get into some complicated business, you can get a report that's 1,000 pages thick, and you got PhDs working on it, but it doesn't mean anything. You know, what you've got is a report, but you won't understand that business, what it's going to look like in 10 or 15 years. The big thing to do is avoid being wrong.
So you get a little bit of humor here at the end, but what he's saying, the main message there is to understand the business that you're in. Projections are one thing. We don't know what's going to happen in the future. He goes on to add this additional piece, so let's take a listen here.
It's just ridiculous. I do not understand why any buyer of a business looks at a bunch of projections put together by a seller or his agent. I mean, you can almost say that it's naive to think that has any utility whatsoever. We just are not interested. If we don't have some idea ourselves of what we think the future is, to sit there and listen to some other guy who's trying to sell us the business or get a commission on it, tell us what the future is going to be, like I say, it's very naive.
So we have here talking about how the sell side, these analysts work hand in hand with management to work out projections. These analysts are often paid, and they do overstate. So for you to take that into consideration, it's completely unfathomable. Do you have a crystal ball? Can you determine what's going to happen? Just listen to your gut, have an understanding yourself, and just see if you see that business around in 10 or 20 years. So we have the exceptional business or exceptional results portion covered. We'll go in and we'll talk about good management and the two metrics that Warren looks for in management.
Well, I think you judge management by two yardsticks. One is how well they run the business, and I think you can learn a lot about that by reading about both what they've accomplished and what their competitors have accomplished, and seeing how they have allocated capital over time. You have to have some understanding of the hand they were dealt when they themselves got a chance to play the hand. But if you understand something about the business they're in, and you can't understand it in every business, but you can find industries or companies where you can't understand it. then you simply want to look at how well they have been doing in playing the hand essentially that's been dealt with them. And then the second thing you want to figure out is how well that they treat their owners. And I think you can get a handle on that oftentimes. A lot of times you can't. I mean, there are many companies that obviously fall in somewhere in that 20th to 80th percentile, and it's a little hard to pick out where they do fall. But I think you can usually figure out. I mean, it is not hard to figure out that, say, Bill Gates or Tom Murphy, Don Keogh, or people like that are really outstanding managers. And it's hard to figure out who they're working for. And I could give you some cases on the other end of the spectrum too. It's interesting how often the ones that, in my view, are the poor managers also turn out to be the ones that really don't think that much about the shareholders too. The two often go hand in hand. But I think reading of reports, reading of competitors' reports, I think you'll get a fix on that in some cases. You don't have to, you don't have to make 100 correct judgments in this business or 50 correct judgments. You only have to make a few. And that's all we try to do. And generally speaking, the conclusions I've come to about managers have really come about the same way you can make yours. I mean, they've come about by reading reports rather than any intimate personal knowledge or knowing them personally at all. So read the proxy statements, see what they think of, see how they treat themselves versus how they treat the shareholders, and look at what they have accomplished, considering what the hand was that they were dealt when they took over, compared to what is going on in the industry.
The part that stuck out to me the most is that Warren doesn't have any insider information. He's doing the work like you and I. He's reading through the proxy statements. He's looking to see what managers are in for the shareholders, in for growing the business. And he's also taking a look at how that business compares to others in its industry. So obviously it gives me hope that you and I can also do the same things that Warren is doing. So those were two important yardsticks and something that, I've kind of added into my research premise when I'm looking at investing in new companies. But the next point that he's going to make is what he talks about inefficient markets and how sometimes you just get those perfect buying opportunities.
The market does not do that. In the stock market, you get a chance to buy businesses at foolish prices. And that is why we end up with a lot of money in marketable securities. If we absolutely had our choice, we would own we would own 3 times the number of businesses we own outright. We're unlikely to get that opportunity over time, but periodically we'll get the chance to find something that fits our tests. And in between, we will, when the market offers us the right prices, we will buy more, either businesses we already own pieces of, or we'll buy 1 or 2 new ones. Something's usually going on.
So we see here that they would prefer, their preferred method of buying a business is to buy it 100% outright. But often when he's going in to talk to these business owners, they do know the true value of their business and it's not being affected in any way by buyers and sellers in an open market. That's where he talks about the stock market and finding opportunities, which gives me a lot of hope, which means, if you see a good business getting absolutely, capitulated in the market, it may be giving you the perfect entry price. And he talks about, the efficiencies that happen there and all the opportunities that it garnishes. So we should be buying when your favorite stock dips instead of actually selling, what a lot of people do. And obviously psychology has a lot to play in that. Well, yeah, that's definitely something to consider, especially if you do see great companies, your FANG names, or if there's a particular company that you jive with. But yeah, moving on, we're going to be moving into the interest rate segment. And if Warren actually uses that as a key metric when he's looking to make a new position.
Well, the value of every business, the value of a farm, the value of an apartment house, the value of any economic asset is 100% sensitive to interest rates, because all you are doing in investing is transferring some money to somebody now in exchange for what you expect a stream of money to come in over a period of time. And the higher interest rates are, the lower the present value is going to be. So every business by its nature, whether it's Coca-Cola or Gillette or Wells Fargo, is in its intrinsic valuation is 100% sensitive to interest rates. Now the question as to whether a Wells Fargo or a Freddie Mac or whatever it may be, whether their business gets better or worse internally as opposed to the valuation process, because of higher interest rates. That is not easy to figure. I mean, GEICO, if they write their insurance business at the same underwriting ratio, in other words, they have the same loss and expense experience relative to premiums, they benefit by higher interest rates, obviously, over time, because they're a float business and the float is worth more to them. Now, externally, getting back to the valuation part, the present value of those earnings also becomes less then, but the present value of Coach earnings becomes less in a higher interest rate environment. Wells Fargo, it's whether they earn more or less money under any given interest rate scenario is hard to figure. There may be one short-term effect and there may be another long-term effect. So I do not have to have a view on interest rates, and I don't have a view on interest rates, to make a decision as to an insurance business or a mortgage guarantor business or a banking business or something of the sort relative to making a judgment about Coke or Gillette.
The next piece of advice is something that I've definitely taken with a grain of salt. This is one that I need to start implementing, and it's something that I need to keep reminding myself, and it's the macro factors do not matter when it comes to evaluating an individual business. So let's take a step back. Let's listen to what Warren has to say about macroeconomics.
You may have trouble believing this, but Charlie and I never have an opinion about the market because it wouldn't be any good, and it might interfere with the opinions we have that are good. If we're right about a business, if we think a business is attractive, it would be very foolish for us to not take action on that because we thought something about what the market was going to do or anything of that sort, because we just don't know. And to give up something that you do know and that is profitable for something that you don't know and won't know because of that, it doesn't make any sense to us, and it doesn't really make any difference to us. I mean, I bought my first stock, I think, in probably April of 1942 when I was 11. And since then, I mean, actually, World War II didn't look so good at that time. I mean, the prospects, they really didn't. I mean, we were not doing well in the Pacific, and I'm not sure I calculated that into my purchase of my 3 shares. But I mean, just think of all the things that have happened since then. You know, atomic weapons and major wars and presidents resigning and all kinds of things, massive inflation at certain times. To give up what you're doing well because of guesses about what's going to happen in some macro way just doesn't make any sense to us. The best thing that can happen from Berkshire's standpoint, we don't wish this on anybody, but over time, is to have markets that go down a tremendous amount. I mean, we are going to be buyers of things over time. If you're going to be buyers of groceries over time, you like grocery prices to go down. If you're going to be buying cars over time, you like car prices to go down. We buy businesses. We buy pieces of businesses, stocks. And we're going to be much better off if we can buy those things at an attractive price than if we can't. So we don't have any fear at all. I mean, what we fear is an irrational bull market that's sustained for some long period of time. You as shareholders of Berkshire, unless you own your shares on borrowed money or are going to sell them in a very short period of time, are better off if stocks get cheaper, because it means that we can be doing more intelligent things on your behalf than would be the case otherwise. If you're right about the businesses, you'll end up doing fine. We don't know, and we don't think about when something will happen. We think about what will happen. It's not so difficult to figure out what will happen. It's impossible in our view to figure out when it will happen. So we focus on what will happen. This company in 1890 or thereabouts, the whole company sold for $2,000. Got a market value now of about 50-odd billion. You know. Somebody could have said to the fellow who was buying this in 1890, you know, you're going to have a couple of great world wars, and you know, then you'll have the panic of 1907. All these things will happen. Wouldn't it be a better idea to wait? You know? we can't afford that mistake, basically. Yeah.
We see that point being made, is that there's so many other risks throughout the market, and there's so many different things that might cause you to not pull the trigger and buy that certain security or buy that certain stock. But if you find a good business, and if you find one that you think will be better in the long run, then you should be a buyer at any particular time. Obviously, price is a huge indicator, but if you could buy it on a dip, he did talk about he wants grocery prices. Like if you're a buyer of groceries, you want those to go down. Obviously, if you're a buyer of a particular company, you want to continue getting in at a lower rate. So definitely a lot that I learned there. Sometimes I personally get caught up in the macro factors, whether it's politics or economics or oil prices. There's so many different things that I take into consideration where it's like almost like dumb it down. Like, is it a good business? Is it going to be better off in 5 years? Well, then, is the valuation right? Well, you should be a buyer. So that's definitely of this, 1994 Berkshire meeting, probably the one that I've taken to heart and the one that I've understand the most. But let's take a look at what they say about speed to market. This was a question in 1994, and obviously now fast forward to 2021, an even more important question. But let's take a look and listen as to what they do in the marketplace.
We perform about like we were doing 30 or 40 years ago. I mean, we read annual reports. It isn't the speed of information really doesn't make any difference to us. It's the processing and finally coming to some judgment that actually has some utility. That is, that it's a judgment about the price of a business or a part of a business, a security, versus what it's essentially worth. And none of that involves anything to do really with quick information. It involves getting good information, but usually it's not. We're not looking for needles in haystacks or anything of the sort. We like haystacks, not needles, basically, and we want it to shout at us. And I would say well, virtually everything we've done has been reading public reports and then maybe asking questions around to ascertain trade positions or product strengths or something of that sort. But we never have to. We can make decisions very fast. I mean, we get called on a business or we can make up our mind whether we're interested in 2 or 3 minutes. I mean, that takes no time. We may have to do a little checking on a few things subsequently. But we don't need to get. I can't think of anything where we really need lots of price data or things like that extremely fast to make any decisions. We've got good management information systems in our operating businesses, but that's just another. That's a question of keeping inventories where they should be and all of that sort of thing. I don't think I think you could be in some place where the mails were delayed 3 weeks, and the quotations were delayed 3 weeks, and I think you could do just fine in investing.
So they make an extremely important point here, is that if you were not able to see the quoted price or what the price was in the market, you should still be able to make a decision on that business. They are able to see if they want to be invested in that company within like 3 minutes or so. Obviously, the main metric that they're looking at is, do they understand the business? And that kind of wipes down the market to such a small percentage because there's stuff that kind of goes over their head. They're not really that big into technology at that point. Obviously, Apple's a new position, but it was just important to see that they're not looking at daily price movement in the market. They're looking at the overall business, what they value at, and what they could potentially see it at in the next 10 years. It's all long-term investing. And that kind of leads me into the next part, is what they think about trading and the time risk that ensues. So let's take a listen to that.
Your time horizon for holding an asset. I mean, if your risk is that if you intend to buy XYZ Corporation at 11:30 this morning and sell it out before the close today, I mean, that is, in our view, that is a very risky transaction, because we think 50% of the time you're going to suffer some harm or injury. If you have a time horizon on a business, we think the risk of buying something like Coca-Cola at the price we bought it at a few years ago is so close to nil in terms of our prospective holding period. But if you ask me the risk of buying Coca-Cola this morning and you're going to sell it tomorrow morning, I say that's a very risky transaction. Now, as I pointed out in the annual report, it became very fashionable in the academic world, and then that spilled over into the financial markets to define risk in terms of volatility, of which beta became a measure. But that is no measure of risk to us. The risk in terms of our super cat business is not that we lose money in any given year. We know we're going to lose money in some given day, that is for certain, and we're extremely likely to lose money in a given year. Our time horizon of writing that business would be at least a decade, and we think the probability of losing money over a decade is low.
I think this is one of the most important lessons as a whole, and I think it's patience and time value. Yes, You could lose money in a day, you could lose money in a week, you could lose money in a year if you're holding on to a particular company. But if you've chosen the business, obviously a good business, over time, you eliminate that time risk. And in over 10, 20 years, you should be able to be profitable at the end. The business should be better off in the future. So obviously he does, that's his prerogative, that's his mantra, and that's something that I try and emulate is, never sell. Buy a good company, continue to add to my position, especially on weakness, and hold that through the longevity until something major happens in the business that I don't value or don't garnish it as greatly as I did before. So this is the 1994 morning session of the Berkshire Annual Meeting. It's a series that I would like to introduce. If you're still with me, definitely let me know if it's something that you find of value. I'm a Warren Buffett guy through and through. This is my particular style of investing. And let me know down below what you think of it. Do you think Warren Buffett is the GOAT, or is he kind of old news now? But I hope you enjoyed the video. I hope you got some value. If you're still here, don't forget, hit that like button, and don't forget, hit that subscribe button if you want to see more of this series. I hope you all have a great week in the markets. Happy trading.